It's Wednesday, July 16th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform Tasty Trade or the website tastylive.com, thank you. Come on over to YouTube, though. Tell us what you think of the market action today, the Trump roller coaster that we all strapped in for this morning when indeed we saw a report from CBS News that Donald Trump was thinking about firing Jerome Powell, went so far as to bring the idea to some House Republicans, and the chummy friends were, well, encouraging him to do so. That was confirmed by the White House this morning. And then about an hour later, Trump came out and said, no, I'm not, me? Fire Powell? Who would suggest such a thing? And the markets quickly snapped back. But it really was a window where the market told you how it would react if that was a reality. Dollar was down, you had gold up, stocks were down, bonds were down. It was that sell America world that we saw in early April. And that early April world gave us a Donald Trump who said things were too yippy to keep going down that path. So he got a glimpse into that window today. And, well, toothpaste back in the tube for now. NASDAQ finishes up in positive territory, and that is a cheeky high close of the year, technically moving above yesterday's close of 23,056.75. We notched 23,000.
Technically is the key word there.
76.50. Dylan, you're overseas. You're watching these fireworks, this topsy-turvy market today. What did we learn from Trump's?
I mean, I really agree with Ilya. I just feel like I feel a reassurance that the bond market's more powerful than the president, because there's no checks and balances in the government. The Congress is useless. The executive leadership of America has no resistance. And if it wasn't for the global bond market, there would literally be nothing to stop the president. And so I believe it's a second confirmation of the bond market's relevance as the final arbiter of what policies will and will not be tolerated. Now, with that said, the dollar's been destroyed, so I don't know. It's not exactly a totally reliable thing. But I think that that the story of the day is the bond market stops the president from firing. If you're writing the headlines for Bloomberg or the Wall Street Journal, bond traders stopped the American president from firing Fed chief.
Ilya, was it the bond market today melting down again? Was it the stock market melting down? Was Tom right that it was the text messages he was receiving, or trial balloon rumor? Is this something we need to pay attention to, is my point, because I look at volatility collapsing across the curve, spot VIX, futures. The market's not saying this is something that we should be worried about.
No, I don't think this is something that we should be worried about because I think it was a trial balloon. I think the trial demonstrated that this is not a road to go down. I think the president went in April and told the markets all kinds of scary things about tariffs and brought out a foam board and did this whole thing. And within a day or two had to walk it all back because the markets told him, no, bad, stop it, in a very emphatic kind of way. We just saw the kind of the temporal life of a similar kind of shock here get squeezed to an hour. So what took him 24, 48 hours last time to realize, maybe even a few days, it took him 1 hour to walk back. So I think very clearly the markets are saying, look, you can't go and mess with the independence of the Fed. That's just not a thing we're going to allow to happen. But that's too far. We will blow up your whole agenda. And I think the thing that immediately sort of sticks out is they sold bonds, so they drove up yields. What could possibly be more counterintuitive to what the president would want to achieve by installing a dovish stooge at the Fed if doing so drove up yields instead of driving them down? So very quickly the markets sort of disabused the White House of the notion that any of this makes any sense. And you can kind of tell by what the president said. When he was asked, he didn't just say, no, it wasn't me. He had command of the details. He came out and said, no, in 8 months is when we'll do this, which would be appropriate. In 8 months, Powell's term expires. So it's not like the president doesn't know what's going on. It's not like this was some off the cuff thing where he's like, oh, whoops, I've said the thing I shouldn't have said. No. So I don't think this is anything to worry about. I don't think we're going to get an attempt to do this. I think we are probably going to get rhetoric around it. And I mean, we saw Mike Johnson come out today, the House Speaker, and say, oh, it'd be good if we had a leadership change at the Fed. Yeah, okay. So we're going to have the conversation. It's not going to be anything to it's not going to be any much more lasting, though, as far as its influence on prices, in my mind, than how we looked at oil during the Israel-Iran conflict. There's going to be jitters around headlines, but I don't think it ultimately means.
But don't you think this? I mean, I said this to Tom earlier on Truth or Skepticism, where like, if you sell oil on World War III and you buy stocks on tariff dips, I think you definitely buy whatever stocks or whatever it may be on Fed Chief Powell firing actions. I think those are all buying.
I don't think you buy stocks. I think you buy dollars.
Okay, fair enough. But but the point is, it's an entry point. It's not going to happen,
right?
And maybe it's.
I wasn't long. I didn't get any more long dollars on this today when the dollar sold off for a hot hour.
Hit its 50-day moving average yesterday.
Didn't exit anything.
Sold off today, right? Yesterday. Hits the 50 today.
But don't you think that there's a bigger issue here, which is that the economy has a drag from these taraffs? Inflation is back. You know, I mean, like we have a real. I feel like we're sort of talking about the soap opera, but meanwhile, there's a foundational problem that is afoot here that is not a good one, my friends. Not a good one.
Exactly. That's exactly right. The PPI data showed it again, and that wasn't helpful, surely. CPI, obviously, earlier in the week. The PPI numbers were a great example of this kind of like, you look at the headline and you go, well, this is okay, right? And then you look like an inch under the hood and go, oh, Christ, this is not okay at all. And so I think now in the second half of the year, Dylan, exactly to your point, you're past the soap opera that was the first half, and now you've got to look at what's actually going on. The problem is the grenade thrower in chief keeps throwing grenades. But the derivative effect of the grenade throwing is a higher cost of everything. I mean, instead of paying attention to the grenades, it's like pay attention to the damage to the terra firma, the restructuring of the foundation of the U.S. dollar isn't what it was 6 months ago, and inflation is back. Right.
Yeah. Well, and people are taking
retail sales tomorrow, consumer confidence on Friday. It'll be a real good test of all of this.
People were taking a victory lap on inflation this morning with the PPI report. PPI doesn't measure imports. So if you're going to measure tariff inflation vis-a-vis PPI, it would only happen through a later stage of the production process,
or really early, which is where it showed up,
like steel, right?
Intermediate trade services margins for the initial stages of the U.S.-based supply chain had their biggest margin squeeze in April since 2012, I want to say. I'll verify that in a second. I've got the chart here, but huge squeeze. They haven't improved since. They haven't fallen, but by the same magnitude, but they've inched and inched and inched lower. That's the biggest in 12 years. Excuse me.
Yeah, no, that's notable though, right? Because if PPI doesn't measure imports, and so you can't measure the tariff impact directly, you'd have to go into a very minuscule line item and sniff it out.
Yes.
And only if there's legitimate pressure in the system would it show up there, and it is.
Yes.
The CPI report yesterday showed that without the weakness in the housing data, tariffs would have had a bigger upside influence on the inflation number. There's actually more weakness going on in housing than I think we've all given any credit to. Maybe that weakness and the reset that you guys have long discussed as what's needed for the housing market, maybe that's actually starting to build in some places where when you look around the country, Nashville, Portland, Austin, Atlanta, some of these places have double-digit year-over-year declines in rent prices. So it's okay. That aside, though, the reaction
and wholesale goods prices in the PPI did go up by the most since February. So it is there.
Right. It's there, but you're not going to see it in the top line. So, I mean,
no, you're not going to see it in the
Vance,
top line because services are falling, and they're falling for the wrong reasons. The biggest decline in services was the traveler accommodations and airlines. So you're seeing that at the front of the supply chain, margins are getting squeezed at levels we haven't seen in over a decade. And at the top of the supply chain, wholesalers are basically belt tightening. They're saying, don't take a flight. Don't spend the money.
Dylan, I got a comment here earlier from someone saying the reason why Trump is pushing on lower rates is he probably thinks that he has some properties that need refinancing due. Why is Trump leaning so hard on these rate cuts? He said that interest rates should be
because
a full
Trump
20 points
believes
lower.
that cheaper money, because Trump's a real estate guy who believes if you reduce rates, you get more action. And he's an action man. Doesn't care about the currency, doesn't care about inflation. And he's a simple math. He's like, listen, if I can get, what's the monthly payment on the mortgage for the building? And if I can drop the monthly payment on the mortgage for the building, the value of my building goes up. I believe he is completely disconnected from the consequences that are manifesting both on the inflation side and on the currency side, and is singularly focused on rates because that's the thing he understands. Or that's the that's the thing he values. That's the important KPI for him, which is if rates are up, the world is lousy. If rates are down, the world is good. Lower and if I get lower, he doesn't understand that lower rates actually going to propel inflation. And he thinks that the solution, my perception, I don't know what he thinks. My perception of what he thinks is that the offset to the drag of tariffs is lower rates, as opposed to I think most economists and the Fed chief believe that lower rates would compound the inflation. There's one worldview, which is lower rates compounds the inflation problems created by tariffs, which I think is the sort of logical economist mathematical view. And then there's the Trumpian view, which is I'm raising the cost of everything on the tariff side. So I need to lower the cost of debt, of borrowing money as an offset to the elevated cost of foreign imports of any kind, while America retools for the next 40 years building domestic factories. So we're going to need low rates for a generation in order to wait for the climate to change enough so that we can grow our own coffee.
That is true. We may have a burgeoning banana and coffee industry soon. Dylan, maybe you have a point there. Ilya, is it just a function of, I mean, I'm thinking about this from the real estate perspective. If he has lower rates, then the value of his property goes up and his cap rates fall, and his investments look more stable to his lenders. I suppose there's that angle. But I think Dylan, you're spot on. Ilya, do you have any critique of what Dylan had to say? Because I have certainly nothing to add there.
No, I mean, I think we're looking at a situation here where the president clearly wants lower rates for all of the various things that we've just outlined. He wants an economic boom, even though it'll be short term, even though it'll be inflationary. because that's what helps the immediate optics. You could run on that in the midterms. I think that's helpful. Never mind that in the back half of the 4-year term here, you're going to have inflation. I mean, it's not like we haven't seen this. What happened with the tax cuts in 2017? Why was the president so mad at Powell then? Because what the president did with those tax cuts is he ramped up inflation, and Powell had to go and hike rates. So it's not like this is shocking. And of course, the president, just as he stoked inflation then and forced the Fed to be more hawkish, just as that happened, but he also started the first rounds of the trade war with China and then crashed an overheated economy. Before COVID, in 2019, U.S. growth was at a 6-year low. The pandemic obviously washes over all of that. Everybody tends to forget because, of course, immediately the following year, we got walloped by something huge. But by 2019, U.S. growth was already very weak. And it was because of the dual impact of, A, the short-term thinking on taxes and their implications for inflation, and then, on top of it, a trade war. So the short-term thinking there. This isn't different. It's the same.
Taking a quick look at the equity markets here, we cover 25 sectors. 7 of them are in the red. The other 18 are in the green, led higher by biotech. Can't help but notice a lot of real estate and bank-related names are leading the way higher too here. IYR, VNQ, throw in a KRE or even an XLF with some of the earnings reports that have come out. On the downside, we see that's the energy names, XOP, OIH, IYE, XLE. SMH took some cream off the top in today's session. But I want to focus on those energy names here because we do find ourselves looking down the barrel at a crude oil market that's now settled back into the midpoint of its range. Dylan, we're not going to spend a lot of time around here because there's no geopolitics, and you've made your dislike for oil unless there's a geopolitical flare clear.
Well, it's not a dislike. I just don't want to. I'm willing to go out on a limb in public and say, listen, I think it's a good time to do. I just don't feel comfortable expressing an opinion about its direction. I don't know. You know, like
sure.
where I don't want to. I hate to say things when I don't have any idea.
No, I think that's a good point, just to be able to say, I mean, all of us I should do that more. Be like, I don't have an opinion on this. This one I actually do have an opinion on, though, Ilya, because the range continues to sideways shuffle. We're sitting right around the midpoint, 63.5 to 65 or so. What's your take on how oil moved today around these headlines? Obviously, Powell gone, growth scare active.
Yeah. I mean, I think you don't get much of anything here absent that spook. So you get a drop, you get a wick, and ultimately you're kind of back to where you were. It doesn't really seem like there's much to consider here. This is still the story of we had a big geopolitical scare. The markets shot up, then were quickly pushed back down, and now they're kind of skidding. It's like a tennis ball that's been dropped from a high and is now kind of bouncing along the ground after the first hit. There's not really anything that's occurring here. We're still kind of in this fair value-ish mid-range. So I think now that we're in the second half of the week and we've sort of seen the first half, which was about inflation and whether the Fed has the green light to go, and the answer is no. Now we're in the part of the week where we ask, well, why do the markets want the Fed to go? We're in the growth concerns part of the week. And really, if you look at the price action in the first 6 months of the year, I've said this recently, you get a very clear story about what the markets are thinking. Yields are down across the curve in the first 6 months of the year, and crude oil ends up with an over 9% loss for all the fire and fury of Israel, Iran, blah, 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 blah. So the markets are concerned about growth. They want rate cuts. They don't see sovereign risks like what we saw episodically today. Why do they want these rate cuts? Why are they concerned about growth? How is oil down 9% in the first half of the year with all of what we saw on the geopolitics side of things? Well, obviously the market thinks demand is a much bigger concern than supply disruption. And in the second half of the week here, we're going to get retail sales, and then we're going to get the consumer confidence number. And if all of that is telling us things are soggy at the same time that both CPI and PPI are telling us that tariff-linked inflation is finally surfacing, this is not going to look very good for second quarter GDP numbers or thereafter at all. And in the first quarter, we already had weak consumption. As I've been saying, the weakest in almost 2 years. So if all of this adds up to we have weak consumption, which means weak growth, and the Fed cannot and will not do anything about it, a cyclical asset like oil isn't going to find it to be smooth sailing. But I don't think you have the confirmation to be a seller here. I think you've got to essentially wait for a clean break, let's call it sub 63, where you have that center line there. And then it's a sell down into the 50s and maybe further.
Yeah, I'm still leaning the short iron condors there, just like I am in notes and bonds still, which today a bit of a bounce back. I was looking a little stickier there. Dylan, it poses a really, you asked the question, and I think maybe Tom asked the question on the last call, is this done? Is this Powell Trump story finished now? As Trump said today, we're getting someone new in 8 months. He can get what he wants. He just can't get it as quick as he wants. So why bother the market? Let Powell go out with dignity. You get your guy in there. It's all done above board. The rest of the FOMC is not going to resist the appointee like some plant. Why not take a shot at long bonds? We're currently sitting near 111. We just bounced off of the 111 area today. Or is just what's happening in DC too chaotic and the market?
No, I think I like long bond. I like that. I like long bonds, long dollar.
Yeah,
my attitude is on the Trump side, it's buy the dip. When Trump rattles the cage, you buy the assets, whether it's the bond or the dollar. My concern is inflation and an economic slowdown. I think anything that's sort of in this sort of extreme moves, the same as an oil spike should be sold on World War III. The bond I think is all yipped up on Powell termination fears, which makes it, I think, a worthwhile long position. I just don't, the issue is oil doesn't have inflation on the other side. I mean, I guess it does in a certain sense, but if anything, it's sort of, anyway, it's a different, it's relevant in a different way. In this case, if it was just Trump and there wasn't inflation, you'd buy bonds all day, in my opinion. But because the inflation data is there, and because rate cuts are going to be kicked down the road, I still don't know exactly how to decipher how much of the bond is sort of yippiness around Trump and how much of the bond is bona fide repricing of assets because of the return of inflation, because of the Trump tax policies.
Ilya, you're already there. Are you going to stick with it?
Yes. Yes.
Why?
I mean, I think the risk reward at these lows looks good. I don't think that you've really shown anything has been proven wrong here because you're very close to the bottom, going all the way back to those April levels, and really even before that. I mean, if you look at where we are on ZB, these are bottoms that go back to January, and you're basically hugging them right here. So I think the overall story here becomes of just pure risk aversion. of the most basic kind out of a really regular, normal cyclical concern. Oh no, the economy is slowing. Oh no, the Fed won't come to the rescue quickly. This is just baseline de-risking. We're going to need rate cuts. That makes bonds at these levels attractive in the sense that locking in these rates is probably a good idea, because the longer that the Fed lets this thing fester and the more the data makes it obvious, the likelier it is that they really do have to cut, and then yields come down. So why not lock them in here? You're probably near some kind of a cycle top as far as rates go. You have all the reason in the world to look at long-term bonds as some kind of a haven in times of risk-off markets, as, again, we clearly saw in the first half of the year for all the Liberation Day nonsense and the Sell America narrative and blah, blah, blah. 10-year yields fell in the first half of the year. The markets were perfectly happy to buy long-term U.S. debt. There is no sovereign risk concern that anybody really cares about. Now, does that mean that the U.S. is doing fine and managing the fiscal side well? No. It just means that there's no alternative. There's nothing else that's going to come in.
And that was what I was talking to Tom about, because you can sort of just run this thing into the ground, but then it's like where it goes back to 2009. Where are you going to go? Yeah. London? Tokyo? Hong Kong?
There isn't anywhere to go.
You got to come to Milan? Good luck.
Yeah, there isn't anywhere to go.
Load up on BTPs and hope the Italian government doesn't collapse again.
I mean, that shows that's a little bit of a hearkening of the past. Italy is in a very has the most stable government that it has had since World War II, and has the most popular leader in the free world.
Why do you have to say the most stable government since World War II? How many governments has Italy had since World War II, Dylan?
Listen, buddy. Look
at who's the president of since 10 years ago.
I don't see anything funny with this. I don't see anything. Prime Minister Meloni is the most popular world leader on earth, and she has been she is the most popular leader
in the G10 for sure.
She's the 70th prime minister.
Oh, you're telling me the prime minister of Bhutan rates above her? Is there's some? You're telling me that some world leader in country number 77?
I think Mark Carney is up there in Canada at this point.
Now we have to fact check this, Dylan.
Ask ChatGPT. Ask ChatGPT. That's why God invented ChatGPT. But there's no alternative to the United States. I mean, that's why I think you got to like the dollar and all the rest of it. I mean, it's as bad as it gets. Where are you going to go?
Exactly right. At the end of the day, it's a game of liquidity. So, and the 08-09 example is the perfect example. The mortgage crisis, all of the pain is in the U.S. So what do markets do? They buy dollars. Why? Because where else do you get cash that's liquid enough to absorb everybody's margin calls? Nowhere.
Modi currently ranks as the top leader.
According to who?
According to what?
A global survey conducted by Visual Capitalist, which is a company that
he's running a Muslim genocide. That is not a good way to make friends, sir.
And also, there's got to be, if it's a survey, there's got to be a population component.
I'm gonna stand by. This is nonsense.
It's just probably the Pope. I don't know. I'm pulling up the graphic.
You know what? Maybe.
So tell me why I shouldn't buy. The inflation is the only thing that keeps me from buying bonds. What is this? This is nonsense.
This is the list.
Malay is up there.
Morning Consult conducted the polls. That's a reputable polling company. Let's get that ad off the screen. We don't need you advertising. Yeah, there you go. Modi. It's based on polling from each individual country. I mean, so like Modi.
GPT, is Meloni the world's most popular leader? No. Giorgia Meloni is not currently the world's most popular leader.
That's based on the poll that is probably reading here. I digress. So
Nayib Bukele of El Salvador, 91% approval.
That wouldn't surprise
me. When you jail anybody that answers the survey wrong, that's going to happen.
I mean, that'll juice the numbers.
Yeah,
that will juice the numbers.
That's a little bit of a cheat code there for Nayib Bukele.
So okay. we have
Vladimir Putin. Vladimir Putin, number 2.
Oh, off the charts.
78%.
Don't fall out of a window now.
Listen, I think that the dictators rate high because if you don't say yes, you go to jail. I think
right.
I think Modi, because that's right now I got Bukele 1, Putin 2, and Modi 3.
As a former Soviet, I have some familiarity with how this works.
So we turn our attention to the crypto market here, where anti-dollar is still strong. Ethereum up 11.8%. Oh my goodness, that's a heck of a day.
This capital's got to chase something.
Got to chase something. Bitcoin's up 2.87%, closes above 120 here. We see that there's a few pieces of legislation that are making their way through. The Genius Act looks like it passes the vote to go to the floor. Same thing with the Clarity Act. Republicans carried across the line. And so crypto here is having its time in the sun. It's a reversal of yesterday when the legislation stalled out and failed. But moving forward here now, Dylan, because you are a true believer in morals and making money, what's your stance here on Bitcoin? You've been constructive on buying all the shiny stuff. Is this still a shiny object?
No, I mean, I think it is. I don't know what else to say. The short answer is yes. I mean, I'm horrified. I'm disturbed, but I just got to put it in a box and stick it on the shelf and wait for the crypto gods to send me back more money and just not talk about it with the Pope.
Ilya, what is it going to take to get you on this train?
I mean, I'm not getting on this train not for tactical reasons. I'm not getting on it for philosophical reasons. It's just not an asset that I want to own. But I don't really see a particularly compelling technical reason to own it. I mean, even just let's take all considerations of what the ticker is out of the equation. Take a look at a monthly chart, a weekly chart. You're setting higher highs, but momentum's fading. Stocks can't seem to get out of their own way. And as we talked about really all week this week, crypto was mirroring the stock market from the end of last year into the turning point in February, into the turning point in April, into the stalling at the start of, let's call it late May into June. But stocks have since roared higher, and crypto was stuck from late May until basically a few days ago, a week ago, maybe. So this is in many ways catch up to what before a brief deviation for about a month and some change was just a more volatile version of a risk-on asset, just a broad sentiment asset, just leveraged up with Bitcoin level volatility. But this was basically the NASDAQ or the S&P. And then crypto underperformed. So I don't really see anything here that should compel anyone to think that this has a tremendous amount of legs to go. It's going to catch up, but if sentiment is going to turn, as I think we're all kind of looking at and saying, okay, well, the runway for stocks is short on the upside and long on the downside. If that's what this is, in a risk-off scenario where correlations go to 1, high beta assets like this are going to get smoked. So I have no appetite here whatsoever.
Dylan, this is a fun headline. We don't ever talk about this company. Trump says that he's talked with the executives at Coca-Cola who have agreed to take corn syrup out and put sugar back in. Do you have any thoughts on that?
This is like a health improvement.
I think regular
This is a
sugar's healthier.
Maha sort of
But I
thing.
mean, but this is sort of like a demonstration of Maha at work, like taking corn syrup out and putting sugar in.
Yeah, screw those people in Iowa. Let's support the Cuban farmers.
I believe that the screw Iowa concept is long overdue.
Oh,
I
really?
believe oh yeah, I believe the Iowans have been jacking us up for decades with their silly primary and all their ethanol racket and their corn syrup racket.
Ethanol is a racket.
I
Corn syrup's
believe
killing us.
I believe the Iowans, the whole Iowan jackup, is one of the great corruptions of American society.
And they just kind of hide there in the middle of the country.
And meanwhile, they've got everybody fat as a pig. They're jacking our gas with corn. The soil's been completely corrupted and degraded by the nitrogen fertilizer that they use to jack the corn all over the place.
But this isn't a problem you have with the Nebraskans or the South Dakotans. This is a very...
No, because they don't do the first. They're not the bellwether for who's the next president. So the Nebraskans and the Kansans and these other fools are just in there riding on the tailwinds of the Iowans. But the Iowans have got the whole country by the balls, and they're squeezing a little too hard, in my opinion. And I've had it. I mean, we're in a situation where we can't allow the Iowans, just because they dictate the momentum for the fundraising for who the next president is, to poison the entire country, poison the entire country's soil, set a standard for every other state to poison the country. And I could not be more subjectively and objectively in favor of this marvelous decision from the President of the United States to get the corn syrup out and put the sugar in. So that's how I feel about that. Yeah.
It's not where I thought we were going to go with it, but that's a place.
Listen, you asked, I answered. That's
interesting. I don't know if you guys saw the news this week, but MP Materials, they produce magnets. The Pentagon took a substantial stake in this company. So did Apple, which I found to be interesting as well. But this is an immense investment, hundreds of millions of dollars, into a private corporation where the Pentagon basically gets right of first refusal on the magnets that they make. Dylan, is this a step in the right direction? And I say that as someone who thinks we need a robust industrial policy to counter what's happening in China. Should we have more federal government involvement in corporate affairs?
no. I mean, no. I mean, the government needs to have an intelligent tax policy to drive investment, private sector investment, in the development of critical resources. The primary issue with this country is the issue of tax policy. Every single time anybody gets into political leadership, left, right, center, instead of actually addressing the underlying issues of tax policy, they ultimately always come back to allowing the corrupted tax policy to function forever. And then they actually try to exert more centralized control. They're like, I'll take all the money and I'll decide. I mean, they go full Russian oligarch. And instead of having a decentralized, distributed capitalist system, whether it's the Bernie plan or the Trump plan or the Biden plan or the Obama plan or whoever's plan, the plan is always give me the biggest pile of money and I will decide what to do with it. And as long as the instinct is for whoever the political leadership to come out and say, give me the money and I'll decide, the more this country is going to be screwed up. And the more we actually drive a tax policy that encourages distributed pools of private capital to take risk and adapt, then we will see prosperity. So anything that goes towards the control of resources and the consolidation of resources by the Trump administration or any administration, for them to then pick winners and losers, is catastrophic and stupid and destructive to this country and despicable.
I might say
and
all
disgusting.
of that boils down to the Lawrence Lessig argument that if only you were to reform campaign financing such that these interests couldn't then shape policy to their interest primarily via tax policy, you'd solve 9 out of 10 ills that the general population is concerned about.
And also, there's a Supreme Court Justice Brandeis some number of years ago, whose whole operating premise was solve the decision close to the problem. Like the further that the solution creator is from the actual problem, the worse the solution gets. And no one could be further from anything than the central government. And you compound that with the ego, arrogance, and giant budgets of our money. It's despicable. Shame on all of them.
And we may have just lost Chris.
We lost Chris. Yeah, we did lose Chris.
That is how emphatic of a point.
It was my use of the word here. Despicable.
That's right. That's how emphatic of a point.
Now that we're down to a two-man crew, my whole thing with you really is,
yes, sir,
is balancing the Trump buy the dip tariff piece with the inflation risk. Not to come back to that, but that's the thing that I'm actually most interested in from an investing standpoint, despite all my political ramblings.
I don't think that there is a strong case, at least in equities, to say that the Trump rambling about inflation being just noise is a reason to be long risk. I think what we're now going to do is, if the first 6 months of the year was tariffs, the soap opera, and that's noise, the second half of the year is going to be tariffs, the economic consequence. And not just tariffs, but among them tariffs. So there's tariffs and there's tariffs. There is tariffs, the thing that happens when the president types something out on his social media and goes, rah, 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 rah. More tariffs for you and more tariffs for you, and that's noise. And then there is the CPI data and the PPI data telling you that goods prices are starting to creep up. And that's real. So for that reason, I don't think that this situation lends itself to be a buyer of risk. I don't think that if you haven't been a seller near the top of this range, that this is a good spot to be a seller in, because you're at the bottom. And so the risk reward isn't great. So either you get a bounce back to retest the tops of the range. You already have that in NASDAQ. So that's now, I think, an attractive risk reward sell. If I didn't have it on, I'd get it on. S&P, I think, better. It's near the upper half of the range with today's close. That's, I think, an attractive sell. Russell is not. It's closer to the bottom of the range, so I wouldn't put that on if I was putting something new on today. Though, again, I have all of these things on near the top of their respective ranges, basically saying the risk reward is risk goes down, stocks sell off, dollar goes up. And so in my mind, if you didn't buy dollars on the Powell kerfuffle today, maybe you missed a window, but maybe there'll be another. And anytime you see a meaningful sell-off in the dollar, probably until further notice, probably for the next several months, you buy that. And that's sort of how you do it.
Equities are entering a window now where after July 17th through the end of the month, they basically chop around. July 17th typically represents the last day of the bullish cycle mid-month for equities, and then they trade sideways to lower before in the final 2 trading days of the month poking through to a new monthly high. So I think if we're going to follow a seasonal path here, right, if that's informative in any context whatsoever, Ilya, these ranges that we've had since July 3rd, they might persist.
They might persist.
22,800 of the NASDAQ, that's a percent away. You think about the S&P 500 going back down to the bottom side of its range, 62, 40? So 1% from here.
Vol is super cheap.
And is that worth getting worked up over? Like I think my point is it's we're entering a period of time where if bulls can't make hay in the next 2 trading sessions, tomorrow really it ends, but then by the end of this week, maybe we've been exhausted up here. And we need to have a little bit of a pullback as we go through the typical late summer, everyone goes on vacation, take down risk.
Well,
we've seen it every other year.
Exactly. And I think when you look at then what happens from here, right? So let's say this week you've gotten markets shell shocked. You're going to meander. When you look at what's going on next week, you've got a Powell speech on Tuesday. You've got a little bit of housing data on Wednesday. And then you get in the end of next week into the next round of flash PMI numbers. And you get a growth check on all of what we're talking about. If that growth check is disappointing, especially in the US, you've got a real issue and a real catalyst for markets to essentially say, right, okay, we're in the shootout and the provider of Kevlar vests won't open the store. Okay, sell risk, go to cash.
Well, the seasonal calendar here, just to visualize what the market looks like, we've basically crossed to this point in our chart. You can see why August over the past 20 years has produced an average return of 0% in SPX, negative 0.7% for September. So the sun's getting real low around here. If you're one of those believers in seasonality, I certainly am. It tells me that we're running out of time to press to the top side here, and it's better to perhaps operate elsewhere if you want to be blindly bullish. That doesn't mean to take the pedal off the metal for any long-term equity holdings, but calling for another 3, 4, 5% higher from now. Maybe we need a step back. Maybe we need to go down 3, 5% over the next few weeks, clear the cobwebs out, get rid of all the top-heavy breath, and we find ourselves living in a brand new world. Ilya, so that's our S&P, that's our NASDAQ. Our Russell is bouncing at support here today. This is actually a really interesting place because if it's a head and shoulders pattern, we don't break our neckline. And we do ultimately hold the uptrend from those April and June and now perhaps July swing lows here. So there's a few nice things going where you can't, S&P didn't break down, NASDAQ didn't break down, Russell didn't break down, they didn't break out. NASDAQ may have technically put in a new closing high for the year, but that doesn't really tell the full story. Calendar tomorrow, retail sales, those are on docket. We have a little bit more earnings coming up. What do you care about the rest of the week?
Retail sales, I think that's going to be important. And then the University of Michigan Consumer Confidence Survey on Friday. I think that's going to be important because I think, again, those things are going to tell us about the other half of the ledger in this story. If the story is that we want rate cuts and we want them for growth reasons, and the Fed won't give us rate cuts because we have inflation concerns at the same time, then this is where we are. And this is the kind of data that's going to tell us why those growth concerns make sense. At the same time that we, at the start of the week, got a sense of why those inflation concerns at the Fed's side of it make sense. So this is exactly where we don't want to be. A paralyzed central bank can't do anything about an economic downturn.
Sounds like we should stay long gold and Bitcoin. Hey, listen, we're done here today. We're going to end up a little bit early. We'll be back tomorrow, Thursday, same time, same place, 4 p.m. Eastern, 3 Central. So with that, we'll say overtime's out of time. For Ilya Spivak in San Francisco and a Dylan Radigan who is somewhere in Milan, I've been Chris Vecchio. Good luck trading. Up next after a brief break, Macro Money with Ilya Spivak.
See you there, everybody.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Eddie in Texas, what's up?
I'm trying to determine whether or not I should actually feel experienced enough to grow my account. I've been trading for about a year and a half. I've done all the homework. I'm not sure if it's just a market that I got lucky in the past 2 months.
Like, how many trades have you made?
This year so far, about 100.
Yeah, so if you've made 100 trades and it's working for you, then that's not luck. No. That's not getting lucky. That's being freaking smart and doing the right thing. Because you took advantage of an opportunity is not getting lucky. You made 100 trades already. Back when we started building this kind of software, an active trader made like 20 trades a year. What used to be 5 years, you've packed it into a few months. I mean, I wouldn't discount anything that you've accomplished so far at all.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle. Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
I did let off fireworks. I should have brought a video. I honestly have never paid attention to the amount of powder in there. And they say it. So like those are like 200 grams of powder, right? And so I got a 500 one this year. So it's usually me and my youngest Austin. We literally, it's like this. It's like, nah, dead serious. Like I don't mess around.
Tom and I normally park on the same level in the parking garage. And so when I go to get out of my car, I have all my stuff, and I see...
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
What a day, what a day. The president seems to threaten to fire Fed Chair Jerome Powell, then walks it back within an hour after the markets go back to April-like sell America mode. And we get some inflation data that once again make the case that tariffs are starting to surface as a reason for prices to go higher. So now what are we going to do? Well, we have the second half of the week in front of us with some key economic data to put all of this in context and perhaps to give markets another push. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We're going to unpack all of that here as we ask the question. We are not going to get rate cuts in the near term, at least looking at this week's inflation data. But do we need them? And indeed, why are the markets seemingly out here pining for them? So let's first consider what we just saw when we looked at the day's offering of U.S. economic data. Surely the story on firing of Chair Powell is a bit self-explanatory at this point. But when we consider sort of the market response, it is, one might argue, relatively straightforward. We end up with a situation here where the markets basically convulse for about an hour when the news comes out that apparently there was a letter written and apparently also a consultation made with congressional lawmakers around this idea that we are going to have a forced firing of Chair Powell because, of course, the president has expressed acute frustration with the slowdown in rate cuts. And for a while there, the story appeared almost credible. Some major outlets picked that up. And indeed, the White House later confirmed that, in fact, the consultation with officials occurred and that the sort of outlines of the story are, in fact, something that was on the menu. But when asked about it an hour later, the president essentially just said, well, no, we're not doing anything, and we're going to wait the 8 months for Powell's turn to end, and when he terms out, then we'll make a change. So you can see the performance here for the major stock indexes. You get a sharp sell-off here when the news hits. That's this right here, and then subsequently, once the spook is over, everything climbs back. It is notable that with the fall in stocks when this happened, the dollar also sank, again, very briefly, and bonds also fell. So yields actually went up. The irony of ironies here is that the president wants lower rates and wants to fire Powell so that somebody else can come in and be more dovish. But of course, that is not exactly what you would see here if you actually took that action, apparently, because what the markets are saying is if you compromise the independence of the Fed and you create this kind of instability, then there's going to have to be a greater risk premium that's added to U.S. yields, and yields will actually go up. And so you would be doing something sort of directly counterintuitive to that which you want to occur. So not surprising, perhaps, that the president walked this back as quickly as he did. Then you get to the day's economic data. And here we have the producer price index numbers. They follow the U.S. CPI report. This is wholesale inflation, and it was expected to tick lower, and tick lower it did. Both the headline number and the core down here, and meaningful lower levels, actually. When we look at the headline, it came in at 2.3%. That's a little bit lower than the 2.5 expected. The core, which excludes volatile food and energy, that was down to 2.6 versus 2.7 expected. Both of those are meaningfully lower numbers than recent readings. For the headline, this was the lowest in 9 months. For the core, the lowest in 11. And so you have here sort of levels that are certainly eye-catching, but when you look under the surface, you see something that's a little bit more troubling and a little bit closer to echoing what CPI showed us earlier in the week. So taking it apart piece by piece, the most immediate evidence that goods inflation is starting to creep into the picture, much as it did in CPI, is right here. So when you take apart PPI and look at the final demand component for goods, you get this increase here, which ends up being the largest since February, up 0.3% month on month. Why then do you get soggy PPI numbers? Well, the services side, which is a much bigger part of the economy, you get a downswing of 0.1%. And of course, services are a much bigger chunk. So take all of that together and you end up with a situation where overall PPI is basically a goose egg for the month. But then you start to break apart that services number and some troubling details begin to appear. So first, all of the decline is mainly airline passenger services and traveler accommodation services. So that was really the big decline for final demand on the services side. And that basically seems to suggest that wholesalers are tightening their belts. They're trying not to spend money on things that perhaps can be something that's foregone for now, something that's optional. But the much more troubling thing here is when we move from final demand earlier in the supply chain into intermediate demand. And what this measures is margins for wholesalers early in the supply chain. So they're not supplying final goods to be distributed to retailers. They're supplying the intermediate goods that go towards having the final goods that then go to retail. So this is earlier in the U.S. supply chain. And this is where you'd start to find the costs from inflation. If that inflation were linked to, let's say, higher input costs from tariffs. And in April, you see this dramatic 2% margin squeeze early in the supply chain, the biggest one in 12 years, as a matter of fact. And for the subsequent months, including this latest June data, no rebound, just further squeezing of these margins. Now, obviously, these are not the same magnitude squeezes as what we saw in April, in both May and June here, but nevertheless, you're not seeing improvement. You're seeing slower but ongoing deterioration. In other words, wholesalers at the beginning of the supply chain are essentially eating the tariff costs to try to insulate demand. At the end of the wholesaler supply chain, and by extension for consumers. So we're trying to keep demand destruction at bay, essentially, by these companies, like importers, early in the supply chain, eating the cost, the extra cost in margin, and not passing that on. But it looks like their appetite to do that is running out, or perhaps their capacity to do that is running out, because, of course, goods inflation does ultimately perk up at the wholesale level. And, of course, likewise at the consumer level, which is exactly what we saw yesterday when we looked at the CPI numbers. And while, of course, in the CPI numbers, it's still mainly services that account for the lion's share of inflation, 2.24 percentage points out of 2.7 on the headline, we can very clearly see here that the delta here from 221 to 224 is much smaller than the delta on the goods side, from 0.05 to 0.13. In fact, we can see it very clearly here. The swing, the momentum, the thrust in goods inflation in terms of its contributions to overall CPI was 4 times that of what happened in services. And so this is where we start to get the sense that despite insulation at the early part of the supply chain from wholesalers attempting to shield consumers and therefore protect demand, we are starting to see this goods inflation surface. We're starting to see it move into the overall calculus. And of course, with that in mind, we are left with a picture of the overall economy much in line with what the Fed has been concerned about. We've heard since March that what the Fed has been saying is, look, we are fearful that, as with most episodes of this kind of a tariff policy in the past, we are going to end up with a situation where the tariffs are going to boost inflation. And these numbers seem to start to show us the evidence of that occurring. And at the same time, it's going to be a hit to growth because it will undermine consumer demand. And with those two things giving us a conflict between our mandates for price stability, that is controlling inflation, and maximum employment, that is sustaining economic growth, we really don't know which thing to prioritize. And we're going to wait while the economy is relatively benign with an inflation rate that's obviously higher now, but still generally manageable, and an unemployment rate based on the latest figures, likewise not the worst of all possible things by any stretch at 4.1%. In fact, relative to history, that's fairly low. And so we get into a situation then where what the numbers on inflation are saying is that the Fed is likely to remain in this mode, at least for now, because what all of this data then implies is that the Fed is, to some extent, validated in sitting on the sidelines and saying, we're going to wait. We don't need to be making any radical moves here. We don't yet know how this mix of inflation and growth concern is going to work out. But of course, from the market's perspective, there isn't the controversy. In fact, if we take a look, as we oftentimes do, at what the markets are baking in for Fed policy, as opposed to what the situation looks like for Fed officials, what we find, as ever, is that for the markets, the controversy has been solved, and that the concern is growth and not inflation, and that the place to go here is to start cutting rates. That's, of course, exactly what we see when we look at what Fed funds futures are baking in here. They're looking at 110 basis points in rate cuts between now and the end of next year. And when you compare what that stacks up to, when you look at what the Fed is suggesting, that, of course, outstrips the Fed by at least one, if not more, rate cuts. The Fed, in its June update, had just 75 basis points on the menu. And that's essentially a breakdown of 2 cuts this year and 1 cut next year. Whereas what the markets are saying at this point is the Fed is going to be more delayed and so wrong on doing 50. They have only 40 basis points baked in for this year, not so far from the Fed's calculus, but sort of questioning whether after this inflation data they can manage even that. But then for next year, we're looking at 69 basis points against the Fed's single quarter point cut. And so the markets are leaning in the direction of 3, outstripping the Fed's calculus by almost 2 full cuts. So the market perspective clearly is that the Fed should be prioritizing growth, and the delay is unwarranted. Against that backdrop, we're going to get a test of just why the markets think as such. With U.S. retail sales numbers on the board, the expectation is that we're going to get a decline of 0.1%. That would be a nominal improvement after a 0.9% fall in receipts in the prior month, but hardly anything to celebrate because, of course, if the consumer were motivated, these numbers would look meaningfully higher, and that motivation clearly seems to be there because these tariff increases that have been put on pause since April are due to expire now at the beginning of August, but of course were due to expire until very recently when they were delayed on July 9th for all countries except China. China's deadline mid-August, the deadline for all countries excluding China now August 1st. And so there was a potent impetus in June for consumers to try to front run, especially as costs rose. But if that didn't happen, well, then consumers are already so downbeat that they're not even chasing the pre-tariff bargain, much as they did, by the way, earlier in the year. This 1.7% surge in March is telling that story. Now, this is what makes the market concern appear so acute. Already in the first quarter, if we take out all of these shenanigans with the front running of tariffs at the wholesale end, this vast surge in imports, the vast surge in the investment component around the building of inventories, where, of course, all those imports went. The larger story is this very weak contribution to GDP from consumer demand. And that, of course, is exactly the issue here. If you have a consumer that's weak, that is a much bigger sort of a concern than whatever shenanigans you have on the trade side, because consumption accounts for 68% of GDP, whereas the trade side, netting out imports and exports, is less than 5%. And so as you look at all of this sogginess in retail sales, assuming it comes out relatively in line with forecasts, as you look at then the picture on inflation, what you end up with is the worst of all possible worlds. The most important part of growth is flagging, and the Fed isn't going to come and help in the relatively near term. Which, of course, speaks precisely to the price action that we saw, as we've been talking about on the show for a couple days now, through the first the first 6 months of the year. What we're looking at is a situation where we have clearly a bet on rate cuts, with the front end of the curve going down in yield, and the dollar, of course, moving in tandem with some pretty explosive losses here against gold, against the euro, against the yen. Stocks being very flattered by this dollar sell-off. Indeed, as we can see here, with stocks having increased less than the euro or the yen, in non-dollar terms, U.S. stocks are actually down for the year, adjusting for the exchange rate. But more importantly, crude oil is down 9.2% for all the fire and fury in the Middle East. So we put all that together and we say, well, the markets see lower yields, weak demand for commodities, and a weaker dollar. And stocks are not exactly the risk-off or the risk-on champion that their valuations would suggest. This is not exactly a story of a buoyant business cycle. So the markets are clearly onto something here, and the Fed is clearly making it apparent that they're not going to act while inflation is doing precisely the thing that they were worried that it might. And so the upshot then for markets becomes, well, what is there left to do but to raise cash and de-risk portfolios? If there's going to be some kind of a negative economic outturn and help is not immediately on the way, then the mindset among investors goes from sort of the usual attempt to maximize returns to a more defensive perspective aimed at protecting as much capital as can be protected. That probably means there is divestment from risky assets like stocks and Bitcoin. It probably means capital going into the relative liquidity haven that is the US dollar. As we saw in the first half of the year, the dollar is clearly not selling off for some sort of displacement by other currency reasons, because this decline in 10-year yields very pointedly says that there's no shortage of appetite for U.S. sovereign debt and no real attempt at replacing the U.S. at the bedrock of the global financial system, as though that were even possible in any kind of a near-term sense. And so the dollar then begins to stand out as a haven once again, a haven of liquidity. You probably likewise get some support at the long end of the curve on bonds and get a rally there, again around the same logic. If the impetus isn't maximizing returns, then why not lock in yields at these relatively elevated levels if what we're expecting downwind is an expansive rate cut cycle, as the Fed perhaps even next year catches up to having been delayed and dragging its feet this year. And so were the retail sales number to disappoint, a lot of the pieces of this story would appear to start to come together. That is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
My dad, who was trading options in retirement, introduced me to options trading. He said, you have to check out this tastylive site. The way they taught options was very accessible and easy to pick up. I think a lot of people think that options trading is gambling, but it's not. It is simply probability and taking an educated guess. It's more like insurance. People should watch Tasty Live because you can pick up a lot of information in a short amount of time, and it's actually practical. You can use it to make money, most important part.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. Across from me is Dan Cecilia. And with us today, of course, fan favorite, Greg Magadini, Director of Derivatives at Amber Data. Greg, what's up? Just dropped my phone.
Hey,
Apologies.
how's it going? Happy to be here. Thanks for having me on again.
Yeah, absolutely. Thanks for coming back. Every time you're on the show, it seems like we're hitting a new all-time high. So we're going to keep this cadence going. Greg, it feels good again, man. Not that it didn't feel okay last time, but we're feeling better and better by the day in this bull market. I guess let's just start there. Bitcoin at all-time highs. ETH, BTC looks like it's maybe breaking out of the downward trend it's been in. Across the board, what are you looking at? What are you seeing? How are you thinking about the markets right now?
Yeah, well, one of the things I do want to contextualize, I've always said this in crypto, what's scarier, a world where Bitcoin is worth 0 or a world where Bitcoin is worth $1 million? I think we're on the latter half of the escalation, but one of the themes I'm keeping in mind here is that we had a big shift in monetary policy in the 1970s when we left the gold standard, and gold basically went from $35 an ounce in 1970 to $700 an ounce in 1980. 20x essentially is what happened to gold. And I'm really seeing, potential macro trends that are kind of similar. Today we had the rumors that Trump was going to get rid of Powell, and that really sent the long end of the yield curve a lot higher because Trump's plan is to essentially crush short-term interest rates at the expense of long-term interest rates. And that's a little bit of an inflationary force, or maybe a lot of bit of an inflationary force. Great for crypto, great for hard assets, but definitely something that's a game changer in terms of sort of policy and how things work right now. So that's the scary world of $1 million Bitcoin, but very good for trading environments and for Bitcoin holders. So that's kind of the context that I want to just mention off the top here.
Do you think, beyond kind of the big picture macro, obviously shifting monetary policy environment, do you think that's what's kind of behind this bid recently, why we're at all-time highs, is that in some ways you might be seeing, I struggle to say that there's a shift away from the dollar, but there might be some cracks that have emerged. I think we've talked about this before, 2022, everything kind of changes with the sanctions that go in place and the assets that are seized post the invasion of Ukraine. Does that, in your opinion, kind of send shockwaves across the system? The cracks emerge. Is that in any way behind kind of what we're seeing, why Bitcoin's at all-time highs, why you're seeing institutional participation? Is it a move against or away from the dollar?
So in part, it is a move away from the dollar. So to me, that's the Bitcoin is digital gold narrative, and you have gold at all-time highs. Gold in October 2023, just 2 years ago, was like $1,800 testing $2,000. And now we're at $3,300. So I think there's that aspect of it. But then there's the other aspect where, we have the procedural vote passing today to vote on the Genius Act, the Clarity Act, the Anti-CBDC Act. So that's very bullish to the blockchain industry specifically. Then you have the notion that stablecoin issuers like Circle are going to be big buyers of the front end of the curve, which is how the administration plans on refinancing debt at the short-term T-bill level because it's going to crush down interest rates. That's why he wants to get rid of Powell. So that's another kind of juxtaposition or coming together of the macro and the industry specific micro. So that's kind of interesting. And then lastly, we have this, huge rally in tech stocks, AI stocks, and that really plays nicely to the risk on world of Web3, which is really where kind of Ethereum shines, Solana shines. And in the case of Ethereum, for example, 65% of the outstanding stable coins of Circle are on EVM chains. And so, again, we have that very industry specific development happening at the same time. So I hate to just point at only macro. I just think it's kind of a conflation of all of these three things at once. And that's really making the market essentially a fear of missing out, rally higher type of move that we saw today.
Yeah, I think it's a good point. And you mentioned ETH, and I think you spoke about ETH last time you were on. We finally saw this ETH BTC ratio kind of move up, break that downtrend that's been going on since over a year ago, 2024. You said it was undervalued the last time. Is there anything in the options markets or anything that you're looking at specific to ETH that could tell us where we're going next?
Yeah, I'd love to actually just share my screen here because there's a couple things, both in the futures markets and the options market. So one of the things I just want to show, just to contextualize, where ETH has come from and where it can go in terms of pricing of futures and the basis. Back in December, the basis was 18%. Today we've rallied from 4% to 7%. So that's kind of interesting. But just to show the difference in sentiment. So when people pay for leverage and pay a higher funding cost, they expect the asset to rally. That's why they're willing to pay the funding costs. If we look at the orange line here on the left-hand chart, that's the funding cost year-to-date accumulated for Bitcoin. Call it, 2.5%, 5% annualized. In ETH, we're just flipped back towards positive funding for the first time in 3 months, so to speak. So that's kind of an interesting phenomenon where we're seeing sort of a differential in pricing. But then if we look at the options market, here's the real story in my mind. If we look at dealer positioning on Deribit, essentially dealers are just short gamma all the way through to $4,000. And so there's kind of like an air pocket here. The process of getting from, call it 2,500 to 3,000 is probably going to have been a lot longer than getting us from 3,000 back to 4,000. And 4,000, we were just there back in December, and that was December of last year. If we look at the open interest across CeFi markets for futures, well, notional open interest, which factors in the price of the asset, has just had a high in December of last year, and that has just been exceeded, even though the asset is still not back at $4,000. So there's a huge increase in the participation in the futures market. So I think this is kind of interesting in terms of the participation of traders in ETH, and not to mention we're seeing the inflows into the ETFs. And if we look at the liquidation data, a lot of buy to close liquidations from the ETH shorts. So it's really a sentiment shift in Ethereum, and there's a good amount of reasons for that as well.
So, Greg, when you look at dealer positioning there and you talk about the speed at which we possibly could move from 3 to 4, are you alluding to a gamma squeeze when you look at option positioning in this expiration because dealers have to hedge that exposure if they're negative gamma?
So normally I would say yes, that's how I would look at it. Again, crypto vol is still such a small space that we're not at the point where the tail wags the dog yet. It's still too small. But it's a really good gauge of sentiment nonetheless. So we know that the street is essentially just buying a bunch of call options at these prices, and they want to get long, and there's no sort of drift in sentiment downward. But at this point in time, ETH option markets are still a lot smaller than the underlying asset.
Okay. Kind of sticking with options, sticking with volatility levels here, which when you look at ETH have popped a bit, but Bitcoin, arguably, I think last time I saw it was 39%, 30-day implied, still near a one-year low. Even though we've had the Delta move, do you still believe, and I think you've been absolutely right on this call, we put the trade on the first time that you had mentioned it weeks ago on the show, bought those upside call options or bought that upside tail. Do you still see an opportunity for those types of trades with volatility at the, really at the yearly lows, even though you've had the delta move?
Yeah, I do. So here's how I think about it. The long end of the option expiration time cycle, the thing that I'm sort of betting there is not necessarily that we'll have a huge explosion in vol, but I think we'll have a very one-way directional trade so that the delta will just compound in one way, so that'll exceed the cost of vol on the long term. But in the short term, really when you're trading a lot of gamma, to me, gamma still seems kind of cheap. Like call it the weekly options where we are today. There's so much going on. I mean, is Powell getting fired? Is Powell not getting fired? That'll move the market. Is Genius Act, Clarity Act, Anti-CBDC Act going to get passed, not passed? That'll move the market. We just had CPI yesterday. We just had PPI today. There's a lot of fluid things in the very, very short term that I could just see gamma paying off buyers here, either to the downside or the upside. So there's something interesting there. Medium-term vol is the least interesting in my opinion. I think once we get past the next week or so, we're probably back in that kind of low vol grind, and then we get back to this contango curve, and then the medium term just kind of rolls down the term structure.
Awesome. So kind of sticking with those short-term weekly expiration periods for that trade specifically, or that idea.
Correct. Yeah.
Speaking of that, we took a look at the newsletter. Obviously, that gamma point you made. Is there any interesting options trades that you've seen come in, like big buys, kind of that's trying to capitalize on that, or anything you're seeing in the data there?
I actually haven't looked at it after today. Today's been kind of a crazy day, but I'm sure there's a lot of stuff out there. If anyone wants to check out the platform, we do have like a block trade sniffer, and you could just see all the block trades that go through, but I haven't had the chance to look at sort of the biggest trades going through yet today.
Anything else on your radar, Greg, outside of some of the moves here recently in Bitcoin? ETH we've hit on my screen. I've got it up about 8% versus around a 1.5%, 2% or so move here in Bitcoin. So finally outperforming. I'm not quite sure if we're outperforming yet on a relative basis year to date. Bitcoin over everything has been the trade, at least up until now.
Yes.
So you get all-time highs. It feels good. And inevitably, naturally, everyone starts to ask, well, when is that rotation out of Bitcoin into not just ETH and Solana and other larger market cap alts, but when altcoin season, Greg? Is there anything that you look at here that gives you an indication of whether you want to trade? And I know we've talked about this before, where a lot of your positioning and your activity is in the options markets themselves, not so much spot markets. But just curious, in terms of how you analyze the market, is there anything that you look at that would give you some indication that if I've been long and I've been riding that move higher and higher in Bitcoin, that now I want to start to look at whether it's ETH or Solana or something that's a little bit farther out on that risk curve? Is there anything that you look at for that indication?
Yeah, so one of the things that I want to keep in mind for Ethereum specifically, from a fundamental perspective, is, if we think about Ethereum is a staking asset. So the tradable float reduces in size as more and more ETH gets staked. So right now we have sort of the highest staking percentage that we've had in Ethereum. It's around 30%, or maybe 35, something like that. So all that float is kind of non-tradable. So let's keep that in mind. Now we're also getting inflows of the ETH ETF. So essentially those ETH are coming off change and going into the ETF, which, the ETF is tradable, but that's still kind of a reduction of things on chain, and essentially people are accumulating the ETF, so that's good. And then we have corporate treasuries starting to allocate to Ethereum, which is also kind of a float reduction activity. So altogether, if we get this continued sentiment higher and some of that ETH gets staked, we get the spot staking ETFs, that will be kind of interesting as well. We get continued ETH flows. I think we moved to 4,000 pretty quick. There's no reason to step in front of this train. I know that we jumped, $350 today. That isn't a reason to sell ETH. If anything, I think we're going to slice through this air pocket all the way up back to that December high of $4,000. pretty quickly, which is, again, kind of a catalyst for one of those gamma plays. So I think that's kind of interesting. To me, though, the other interesting asset, and I talked about this last time, is Circle. I think people are really sleeping on Circle. One of the things, like, the main argument that I hear against Circle is that it's too expensive now because it's moved up so much. Again, that to me is not a very convincing argument. Too expensive is, you have to be really certain that you can model out future cash flows of Circle. I don't think you can do that right now. And if I look at pure market caps, again, it's not that big of a market cap. We're talking about 50 billion, give or take. ETH is around the 400 billion. Bitcoin is, couple trillion. So like, it's kind of one of those things that there's a lot of upside in USDC here.
Yeah, I've got the Circle chart up here on the screen. Last price of $233, up $37.87 here today. It's about a 20% move. I haven't been following the news flow that closely today. I'm assuming, and you had mentioned earlier, some things are happening with Crypto Week here with some of the legislation. I'm assuming that some of this move here on Circle is related to that. Would that be correct?
Yeah, 100%. This Genius Act passing and the co-integration of having, Powell maybe being fired and reducing rates and needing a buyer of treasury bills kind of all together. I think there's a lot of fundamental reasons for Circle to be kind of successful in its stablecoin endeavor. Obviously, lower rates are not necessarily good for its T-bill holdings, but the incentive to work with Circle as a buyer of T-bills, I think, is very promising. And the Genius Act really encodes transparency into stablecoin issuers, and Circle's got a huge head start on that. USDT I think is going to lose a lot of market share because of its non-transparent approach to the market. And so as the Genius Act comes online and essentially creates a moat around Circle and the USDC stablecoin, I think they're going to be a big beneficiary. And there's a need for them to exist because there's a need for them to buy front-end treasuries.
Yeah, for everybody that's watching, Greg, last time he was on the show, had a great trade idea. Maybe we could walk through that again, Greg, because it was a really interesting way to kind of position this where you're looking at selling a put with a decent amount of time until expiration, but just the return on that capital, if you're trading in a margin account, that you're going to generate as a function of the premium of the put option. Obviously, you have downside risk, but that return versus locking it up into short-term treasuries is quite substantial. So I've got the trade page up here, and you can see that Circle does have an earnings announcement. It appears on August 12th. So that'll be the first since going public. But just to give everybody an idea of this trade, what would be kind of your ideal duration here when you look at where you want to sell that put?
Yeah, so the longer dated you go, the less risk you're taking. The shorter dated you go, the more risk you're taking. And then there'll be a synthetic interest rate differential. But if we just look at, say, the 1 year from now, call it, maybe the June or something like that, and we look at the $100 put, this will give us a good proxy right off the bat, simple math. What's the implicit yield on that? I can't really see what the current price is. It's a little small.
Yeah, so we've got a price of, let's give it a mid price of $11. And we've got a buying power effect here of $2,610 if you're in a margin account.
Yeah, so if you just think about the simple yield, it's 11%. If you think about the current yield, it's really like $11 divided by 89. So call it about 12%. And if you look at the yield on margin, it's pretty high. So all said together, this is a great way to get some of the action without chasing the top if this is a local top.
With these types of positions, is this something where, now granted, the theta decay is not going to kick in for some time, at least on a daily basis, you're not going to see much of a change here with as much time as there is. But is this something where as you get closer to that expiration date with these positions, you manage them, or how do you think about that as this kind of decays over time? I guess my question is, do you get out of this early, or do you wait until you're basically at this point in time next year and hopefully the price of Circle is well above $100 a share?
Yeah, so the way that I view it, I want to own these shares. So for example, if we actually traded down through my strike, I would actually just buy back the put at the loss and actually just buy the shares. And that actually afforded me the opportunity to wait for my prices without essentially kind of FOMOing in at higher levels. So the way that I see it is that the big trade is going to come from owning the shares and riding those to, hopefully $300 billion market cap or whatever, $700 a share, $800 a share, whatever that ends up being. To me, that's where you're going to make the real money. But you don't want to rush into that. So you want to be patient enough to buy the prices you want to buy. So that's kind of the best case scenario in my opinion, is we get the downward move in the shares and then I can actually buy the shares. Now, if we don't really get a downward move and the shares just kind of sit here and there's enough time to decay, I'll do one of two things. I'll either buy back the option and sell something a little bit closer that's a little bit more short dated and kind of hope to get exercise on that and kind of recycle the trade. Or if not, I'll just essentially collect some of the premium, call it half of it, and then end up just buying the shares at whatever the market price is. If we didn't move higher and we're kind of at a decent price and it's just been consolidating, I'll still get into the shares at some point and at least have gotten some action along the way.
Would you consider selling a call against that position? Let's assume you get exercised, you take assignment of the shares. Are you now looking to just ride this higher? You're bullish on Circle, you like the prospects for the company, or is this something where presumably there's still some volatility premium in here? You'd look to sell a call option against that?
Yeah, if you own the shares, earning some yield from selling a call, like you can sell like right now we're at 240. You can sell the 445 call that expires in January for a pretty decent premium. I think it ends up being kind of like 13-14% annualized. I always think that type of thing makes sense because if we just rally to 1440 pretty quickly, you'll probably get a chance to rebuy your shares below that strike at some point anyways if you get called out. So that's one way to play it, or you can just roll up that call as well. But I definitely think generating income if you're going to warehouse the high volatility asset, you might as well generate income from the high volatility environment. Not generating income is kind of like you're kind of wasting away the risk that you're warehousing for nothing.
That's a great point. And I love how you always kind of look at this from that perspective of the return on your risk, return on capital. That's a constant theme here on Tasty Live, but it's really important to look at it that way and always compare it to what you could get with your risk-free rate. And when you think about that, what can be at times a substantial kind of capital outlay. Dan, over to you.
I mean, I don't really have any. I guess like what I'm interested in is, we're in this situation where markets are ripping, altcoins seem to be next, ETH is ripping. Is there anything in your mind that could be a risk, like something to the downside? Because obviously these markets are super volatile. I've been through a couple cycles. On our way to 150, we could still get 20-30% pullback. So is there anything there that you could see as a risk?
Yeah, so to your point, so from the gamma trade perspective, I think as long as we get volatility from downside or upside price action, that essentially pays on the gamma side. I think there definitely is a risk when we get to these kind of environments where things leg up very quickly. The slow grind higher is the true bull market that lasts years and years and years, and assets just compound. But let's remember, 3 months ago, NVIDIA was at $89 or whatever it was, and now we're at 170. That's a pretty big move in the largest market cap asset pretty quickly. So to me, let's keep that in mind. That's a little bit of a risk in terms of market structure, I think. And I can't imagine that if we get risk off in tech stocks that we don't get risk off at least in altcoins or Web3 coins. I think Bitcoin still remains its own beast in the sense that gold and digital gold are moving higher for reasons that's different from tech stocks and Web3 crypto. Obviously, there could always be a risk there from regulation and things like that. I see that more as a stable play, though. I don't see as much risk in Bitcoin for that reason.
Gotcha. And then, we've seen these corporate treasury stocks pop up, right? Like, I think the biggest one right now is that SBET, SharpLink Gaming, was buying up all the ETH. It now holds more ETH than the ETH Foundation. Obviously, you had Strategy, which then he issued like 2 or 3 tranches of preferred shares. And then I think Tom Lee launched another one. I mean, that seems to be bullish for like flows. And like you mentioned earlier, ETH supply kind of coming offline, maybe being staked. Do you think there's any risk with like these treasury companies? Like some of these are just like copies of Strategy. I mean, is there any play there? Do you see like is SharpLink a good options trade? Is there anything you can think of there?
I think the point is a great point. I haven't looked at any specific trades, but one of the things I remember back in, I think this was like 2015 or 2016, oil broke down below $50 a barrel for the first time in a long time. And the CEO, I think of ConocoPhillips, he decided to take off all the hedges on oil. And he was like, all right, take off all the hedges. This is low enough. And I remember reading this comment on, I think it was on Wall Street Journal. And he said, the comment said, you're the CEO of an oil company. I invest in the oil company because I need you to be a good oil producer, essentially. Anyone is able to buy or sell a future. I don't need you to do that for me. If I want to get that exposure, I can go do it myself. And I think that remains true with corporate treasury strategies. I don't need to invest in Strategy to get exposure to Bitcoin. I can just go buy the Bitcoin myself. I don't need to invest in SharpLink to get exposure to ETH. I can just go buy the ETH myself. That used to not be true before we had the ETFs, or before we at least had the spot ETFs. And I think that's a very important thing to keep in mind. Now, obviously, MicroStrategy is giving you a levered bet on Bitcoin, and the funding is not just like this short-term perpetual leverage, but it's actually fixed-term bond funding, just like you have a mortgage on your house and you pay the mortgage. As long as you make the interest payments, you can own the house no matter what the asset price is, so you can hold the volatility. So that's a little bit of a useful vehicle for that. But I think let's keep in mind that at the end of the day, just buying an underlying asset is not a very valuable business proposition. So I want to keep that in mind. And then the second point is, leverage can cut both ways. Fixed term leverage is a little bit safer than essentially margin. So that's good. But if we actually did get a big crack or a huge shift in sentiment, probably a pretty good short.
Greg, couple more questions for you before we wrap up here. One, I want to ask you about kind of the Bitcoin volatility profile right now. And given, as you've said, it is its own animal. It's in a class on its own. It's driven by different factors. One of those possibly being, a shift in terms of the perception of the asset by much larger institutions. Pools of capitals go so far as kind of sovereign nations or sovereign wealth funds, at least. Given that, does the price matter? And what I mean by that is today at 120,000 with the participants that are entering into this space, do you think that the volatility ever goes back to what we've seen in prior years? And sure, there's tail risk, but with who's participating, does it matter to them if we get excited if it goes to 120, from 120 to 150? Does it matter if it's $500,000 or if it's 300,000 or if it's 1.2 million? Will we be thinking about it differently? Just given, I suppose, why these pools of capital might be investing in this? Like, how do you think about that?
Yeah, it's back to the full circle of what's scarier, $1 million Bitcoin or $0 Bitcoin. But to your point, I mean, if fiat is losing its purchasing power, then it's just kind of a stupid number. Like, it doesn't matter if it's 1 million or 2 million or 10 million. It's a stable value of money. Again, if we think about 1970 gold, $35 an ounce. I mean, gold was $35 an ounce for a long, long time, and now it's $3,500 an ounce almost. And 1970 is just 55 years ago. That's a huge jump. So if we rebase Bitcoin, $100,000 Bitcoin, call it $35 an ounce gold, in 50 years, it's a pretty big multiple. That's 100x essentially. Can Bitcoin be worth $10 million in 50 years? I mean, it's been done before in gold as the asset. I think the big distinction is that gold's been around for thousands of years and it's been accepted. Bitcoin's a little bit more of a new technology, so not everyone's as bought in at this point.
I have one from the chat, Greg. Will 100K be breached again, or have we found a new bottom?
So the way I would think about this, 100K, I mean, you can just do the volatility math and figure out what's the probability that we break 100K. I think that's probably the base scenario to keep in mind. It's just a normal distribution of volatility and what it looks like. I don't think 100K is like a rock solid wall, like support floor that never gets broken. We just saw it broken a couple weeks ago and quickly got bought back up. So I wouldn't be surprised. And let's keep in mind that, I've been in crypto for a while. I've seen a lot of 80% pullback bear markets. If you think about owning Bitcoin from the beginning, it's not as easy as it looks to hold something that went up and is worth a lot, and then you watch all your wealth disappear because you're in the middle of a 90% drawdown. So we'll probably get another opportunity to buy 100K.
Right.
Yeah, that's a great point. Last question for you, Greg. ETH, we're bullish. Is there a price target in mind just for fun? We never hold anybody to this. My price target for this cycle, and you can watch this on the Tasty Crypto YouTube, is 30,000 if the math plays out the same way that it has in prior cycles. Rudimentary analysis, but that's a 10x basically from here. Entirely possible, though it's a big number for people. With the rally that's underway, is there a point where you take profits or you see, given option positioning, there's the potential for this to possibly slow down? It could exhaust itself, but kind of what's the number that you have in your mind?
So the way I'm thinking about it is more from a short-term perspective, but I think we don't slow down right here, and I think we're at $4,000 in 10 days type of deal. I think there's a lot of interesting sort of gamma plays to be done in the short term here, and that makes a lot of sense to me. There's so much pent-up catching up to do in ETH, and pretty much the asset is under-owned, and the sentiment has clearly shifted. I think it just rallies very quickly, just like Circle rallied really quickly right out of the gate. It was worth $64 as the first trading opening price, even though the IPO was $31, and then 10 days later it was worth $300. So don't underestimate how fast these things can move, and the move that we've seen today is a reason to buy more, not to sell.
Awesome. Well, we appreciate that. We're going to leave it there. Greg, before we wrap things up, if anybody's interested in getting in touch with you, reading your work, you put out a great newsletter every week. Where can they find you?
Yeah, you can go check out our website, pro.amberdata.io. That's going to be our website. We can look at all the vols and things like that. You can sign up with a free email. And then we also have a Substack where we write our weekly newsletter, which is amberdataderivative.substack.com.
Awesome. Well, thank you very much for coming on the show. As always, looking forward to having you back here soon. But that's going to do it for our show. Hopefully we see 4K ETH in the short term as well. We'll be back next Monday. Until then, I'm Ryan.
I'm Dan.
Peace.